according to ICA, this is same chapter, that is security valuation, chapter number 1, 2, 3, 4, chapter 4. Chapter 4 or chapter 5? Chapter 4, I think. I'm not recollecting. Chapter 5. Chapter 5. First is that introduction, second is risk, third is capital budgeting, fourth is security analysis, fifth is security valuation. Correct. Chapter 5. Now, what is a bond and what is a debenture? Bond is a debt instrument issued by institutions like, government institutions, financial institutions, etc. Debenture is a term we use for corporates, private companies. So when private companies raising debt by issuing a paper or a security, we call them debenture. But if a state bank or any government company is raising money through issue of security, we don't call debenture, we call bond. Now ONGC, when they come to market, it's a public sector company. You will never read ONGC came out with a debenture, ONGC bond, NTPC bond, public sector company. So public sector company, financial institutions, banks, they use a term bond. Otherwise, valuation absolutely same. No change whatsoever. Okay. So you are learning debenture, you can think so. What we are going to learn in this chapter? We are going to learn pricing. How to price. We are going to learn measurement of risk. Measurement of risk. We are partially going to learn management of risk. Not in detail. Management of risk. We are going to learn forward rates. We are going to learn about convertible bonds. So we have got other 1 or 2 topics, small topics, that also we will learn. So this is the main thing. So what is you get approximately 8 marks in this, and usually students don't prefer this. According to me, this is one chapter where you require brain. Other chapters you can manage somehow here and there by doing here and there, but this chapter you must know the concept very well, and it's a very interesting chapter. I told you that it requires brain, so you will not find many preferring this chapter. I will not say it is difficult. It is not in the difficult category, neither it is in the easy category. The previous chapter was fairly easy. Derivative, according to me, if you know the financial jargon, it is very easy. If you don't know financial jargon, it is the most difficult one, derivatives. So this chapter is moderate. Now let us actually understand, when we talk of a bond and debenture, there could be some differences. The differences, they won't ask an exam, but just for knowledge purpose. When a bond is issued, stamp duty is paid like on any other security, and that stamp duty goes to central government. Whereas in a debenture, the stamp duty goes to the state government where the registered office of the company is located. In the case of debenture. In debenture, for both issue and transfer, you have to pay stamp duty. Here, only on issue, you have to pay stamp duty. Okay. Now, in bond, we call the interest as coupons. There we call as interest. Okay. Now, these are the minor differences which will not affect our chapter at all, means affect our learning in any way. Now, suppose a company want to issue a bond, then it will tell me 3 things for sure. I am writing, that is called face value. I write BNS face value. Any company, when they are going to issue a bond, they have to tell what is the face value of the bond. Usually we take it 1000, your institute regularly violate this, and either they will give 100 or 1 lakh, so that students are thrown out of comfort zone. So you are doing problems, all problems with 1000 face value. Suddenly in the exam, if you get 1 lakh face value, you tend to write wrong coupons. Every bond will be given a particular coupon. Coupon rate will be given. So we call it as C. So rate will be provided. When a company, when an institution is coming out of the bond issue, it will tell you years to maturity, when it is maturing. Now these three things, these three parameters, that is BN, C and N, will be given by the company. It is like something, when a bond is born, these three are coming together. When it comes to market, suppose NTPC is coming out of the bond issue and it is coming out with an issue and it is given to you, either directly or through the bank or through a broker. At that time, you decide your expected rate of return, what return you want, that is your K. So expected rate of return. And this return of, that is K, will decide what is the bond price today. Price of bond. So you can see that bond has 5 parameters: face value, coupon, years to maturity. These are given by the issuer. Number 4, expected rate of return, decided by investor. Decided, or you can say calculated, investor. And number 5, this results in bond price, results in finding theoretical price of the bond. Now let us understand this still better. I said 3 things issuer will tell you. You will decide K. That will help us calculate B0. Now how you do it? Now let us come to Gordon's model. Price of a share is nothing but future dividend discounted. This we have learned. Price of a bond, instead of P0 I write B0. Future cash flows discounted. Now coupon will be same every year. Coupon will be same every year. First coupon discounted 1 time, second coupon discounted 2 times, and you will get face value back instead of PN, BN. You can't hold a bond forever. Once it matures, you have to surrender the bond, you get the value. So here BN is relevant. There we said if he is a permanent shareholder, he will not sell the share. BN plus C, last coupon, upon 1 plus K raised to N. Simple, clear? So this is the price of the bond today. Of this, C is decided by issuer. Investor has no control. BN is decided by issuer. Investor has no control. N is decided by issuer. Investor has no control. But K is decided by investor, which results in finding B0, which he compares with B0 market or B0 issue price. A company is coming with an issue. It will tell I am giving at 1000 rupee face value, or I am giving at face value is 1000. Okay, you are giving at face value. You tell me what is the face value. I will plug Bn equal to 1000. You tell me what is coupon. I will fill C equal to 10%. You will tell how many years bond. I will fill 5-year bond. Then I will go to market, find out this NTPC bond. Generally, what we should expect? You should expect around 10%. Okay, I will substitute K, find out my B0, compare with the issue price, then I decide. So, what is the homework investor does? Estimate K. Estimate K. Are you getting? This full chapter is about K only. So, to summarize, a bond is like a debenture only, and most of the properties, the formula of share and bond is also same, except for in the last term we have got BN, return of face value on surrendering the bond. Three things are decided by the issuer. They are face value BN, coupon C, and N. What is the tenure of the bond? What is decided by the investor? K, which helps us in calculating B0, bond price today. Understood? Now, if you see this can be written I can write this as B0 is equal to C into PVIF K, N plus BN into PVIF K, N. Almost every problem in the chapter will have PVIF factor. Let us see. C I am getting first year, second year, nth year. So C I am getting every year. Therefore A, annuity. BN I am getting only in the last year. Therefore I am having PVIF. I don't have PVIFA. You can see here. I am discounting every time by K. So K is there. I am discounting for n years. N is there. This I am discounting in the nth year. Therefore we have n. Did you understand this? Okay. Now on the last page of this book, we have got PVIFA table. Just have a look at this. Take the last page of the book. Go to page number 1. ANN Annexure 1. Are you there? Annexure 1. Now it is a PVIF or PVIFA? PVIF. Now what is the meaning of PVIF? Just see, if I do 1 upon 1.08, this is nothing but PVIF 8, 1. Just see what is 8% 1 year. So you do 1 divide in calculator. Do 1 divided by 1.08. How much are you getting? 0.926. You must be wondering, sir, this unnecessarily making us work. In the exam, sometimes they will give you PVI table, sometimes you have to use a calculator. Now, if I want to do, just try this. Suppose I want PVIF 10, 5. How much it is? 0.621. So how I write this? I write 1 divided by 1.1 raised to 5. Now you try to answer this. I want to do 1.08 plus 1.08 square plus 1.08 cube plus 1.08 raised to 4 plus 1.08 raised to 5. What I do? How you got this? You go to annuity table or or, or add 8% for 1, 2, 3, 4, 5 years. Okay, so this is 3 point. So this you got from page number 3, 3.993. Now which is a breakup of 0.926, 0.857. You can see on page number 1, 0.794, 0.735, 0.681. So our friend who talks a lot, he has bought a new calculator. Take your calculator. Let me see whether you are telling correctly. New calculator. Do 1 divided by 1.08. Do that. 1 divided by 1.08. What you are saying? Do equal to. Do 2 times equal to. How much are you getting? Calculator is working. Okay. So 0.681. Okay. You are familiar with both now? Okay. Write down. Give the heading bond markets. I'll give you pricing of bonds one by one. Let us do. Bond markets. A bond is a debt security. A bond is a debt security with 5 variables. A bond is a debt security with 5 variables. Number one, BN within bracket face value. Number 1, BN within bracket face value. Number 2, C within bracket coupon. Rate you can write, coupon rate. Number 3, N years to maturity. N years to maturity. Now write in red below that these three variables are available once the bond is issued. These three variables are available once the bond is issued. They are decided by the issuer. They are decided by the issuer. They never change. They never change till expiry, till maturity. We use the word maturity. They never change till maturity. Now write in blue number 4. K within bracket expected rate of return of bond investor. K within bracket expected rate of return of bond investor. Next line write in red. Next line write in red. This is estimated by investor. This is estimated by investor using various principles. This is estimated by investor using various principles, comma, information, etc. Comma, information, etc. before investing in the bond, comma, information, etc. before investing in the bond. Number 5, write in blue, number 5, B0 within bracket price of the bond. B0 within bracket price of the bond. Write in red, this is calculated once we fill the above 4 variables, the first 4 variables. This is calculated once we fill the first 4 variables. Next line, write in blue, the theoretical bond price formula, the theoretical bond price formula is given by, the theoretical bond price formula is given by B0, just copy from the top first equation. B0 equal to C upon one plus K plus C upon 1 plus K square and finally Bn plus C. So in D we wrote D1, D2, Dn. Here there is no Dn. C will be constant. In once issued it will not change. You can issue varying coupon bond, but once issued in the beginning it will not change. A company can say first year I will give 7%, next year 8, next year 9, like that. But such bonds rarely exist. But once the issuer issues, it will not change. So you are written this. Using, next line you write, using PV factor formulae, we can write as, using present value factor, PV factor formulae, we can write, just copy this, B0 equal to C into PV IFA K comma N plus Bn into PVIF K comma N. I want to ask you one thing very frankly. Don't feel shy that what others will think in the class, etc. If you have any doubt of understanding this PVIFA formula, let me know now. I will teach right away. Otherwise, your chapter is going to become more complex. You will have only this throughout the chapter. Everyone has understood this PVIFA, PVIF. PVIFA means if I am getting every year, so I use annuity factor. PVIF means which I am getting in one specific year. Clear? Can I go ahead? Write down. First problem. Example 1. Give the heading example 1. Find the price of bond A. Find the price of bond A if Bn equal to 1000, if Bn equal to 1000, C equal to 10%, N equal to 5 years, and K equal to 10%. And K equal to 10%. What you do now? Once you use a calculator, once you use PVIF table, get used to both. Get used to both. Tell me the answer. Tell me the price of B0. I hope you know how to calculate C. C equal to 10% of face value, 100. Bn 1000. N5. K 10%. This we are given name bond A. So you must be getting the answer equal to 1000. I am putting approximate sign. So 10 paisa, 15 paisa, whatever you are getting, 5 paisa, just ignore that. Is everyone getting 1000? Okay, example 2. If K changes to 12%, find the price of the bond. If K equal to 12%, find B0. I request all of you to be familiar with both calculator and PV table. In case you have done the previous with PV table, use this with calculator. And vice versa. Nine 27.5. Are you getting this? All of you? Anybody still doing? Some heads are down, they are still working. Got 920. Am I going very fast? Am I going very fast? I am giving sufficient time. Till now, we are done now 3 chapters, option, future and DDM. Did I go very fast? Now why? Because if you don't tell me, I will continue with this speed. Okay, is there anyone who is still doing it? Example 3. Now if K changes to 8%, if K changes to 8%, find B0. You have to write what I am writing on the board. Just don't tell me the answer. You should be able to write. And I urge all of you to by heart the first 5 P factor of 10%, which will be extremely useful in this problem, in this chapter, sorry. 0.909, 0.826, 0.751, 0.683, 0.621. You must get familiar with this because in the exam, this can actually help you. What is the answer? 10. Everyone has got this? Everyone, now pay attention. Pay attention. Initially, K was 10%, C was 10%, you got B0 1000. Then K was 12%, C was 10%, you got 927 half. Then K was 8%, C was 10%, you got 1080.30. pay attention, all of you. We are going to learn the first fundamental of a bond. Now, whatever bond gives, that is coupon. Whenever a bond is issued, coupon. So, issuer is telling, look, I am going to give this much coupon. So, coupon is our receipt. Coupon is our receipt. Coupon in the first case. Now, look only in the first row. Bond is giving me 10%. I am also expecting 10%. So, therefore, I am willing to pay the par value of the bond. What the bond gives? Bond always gives coupon. How much it is giving? 10%. How much I am expecting? K. My expectation is denoted by K. My expectation and what bond gives matches. Therefore, I am telling, okay, I am willing to pay the issue price of the bond. So, B0 is equal to BN. So, whatever is the issue price, whatever is the face value, I am willing to pay the bond, to buy the bond. Now, look at situation number 2. Bond is giving 10%. I am telling no, 10% is less. I want more. I want more. I want 12%. Then I am telling, I will not pay 1000. I want it cheap. Because you are giving less than what I want. You are giving me only 10%. I want 12%. Why I should give you what you are asking? What the bond is asking? Bond is asking face value 1000 rupees. So when my expectation is more than what the bond is giving, I am not willing to buy the bond at par. I want to buy the bond at discount. Discount means less than BN. So my B0 is less than BN. It is like, you go to a shop. Now I want a television which has got 10 facilities. Sorry sir, we have a television which has got only 8 facilities. Sorry. What is the price? TV 10,000. No, I will give only 8,000. Because it doesn't have all the facility what I want. Are you understanding? So if the bond is not satisfying the investor expectation, don't buy the bond at par value, pay less than par value. Understood? Situation number 3. Bond is giving 10%. I am expecting only 8%. Bond is giving me much more than desire. So I am willing to pay much more than this price. My expectation is only 8%. Bond is giving much more. You go to a shop, I want a 10 facility television. He is saying, sir, our television has 20 facilities. 20? Okay, my budget was 10,000. Don't worry, I will pay more. Why? It is giving me more than I desire. So when the bond is giving more than your desire, which is C. C is more than K. Or I will say K is less than C. Then I am willing to pay premium. Now you can see the premium is 80 rupee 30 paisa over face value. What is the premium here? 80 rupee 30 paisa over face value. So in this case, B0 is greater than BN. So here we can say K is equal to C. Here K greater than C. Here K less than C. Did you understand? Now mathematical. Mathematical is very powerful. B0 is equal to C upon 1 plus K, C upon 1 plus K square, C plus Bn upon 1 plus K raised to 5. This is the formula used. Correct? Now, in the first case, case 1, this was 10%, this was 10%. So I paid 1000 rupees. In the second case, this was more. Denominators increase. When denominator increase, this value will become less. Yes or no? So when K rises, B0 will be lower than 1000. And last, when K is equal to 8%, numerator I have 10%, denominator I have 8%. 10 upon 8 is more than 1. So I will get the answer more than 1000. Are you able to visualize this? So quickly you have to tell. You know, when you read the problem, a person purchase a bond at discount. Immediately you must know discount mean numerator must be actually less and denominator must be more. Therefore, investor expected return is more. This mathematical equation will help you think very fast. Otherwise, you will think K, C, C, K, you will revolve there only. Are you understanding? So, can you tell me when a bond is giving 20% coupon? Pay attention. Bond is giving me 20% coupon. My expectation is 20%. And the face value of the bond is 100. At what price I will buy the bond? That's clear? Now, bond is giving me 16% coupon. My expectation is 18%. Face value is 1 lakh. I will buy less than 1 lakh. Now, I have purchased a bond at 11,000 rupees. Issue price was 10,000. What is the message? I purchased the bond at 11,000. Issue price is 10,000. What is the message? K is less than C. Understood now? You must actually learn from all now. After some time, now it is fresh, your answers are correct. After some time, I'll ask. It will take some time. Don't, even if it tell wrongly, it is normal. It will take some time to get into it. Summary. Don't write, just write summary. Now pay attention. Let these first 4 columns be narrow. Let first 4 columns be narrow. The largest column should be the last column, comment column. Okay, because when I dictate, then you should not struggle. Let the first 4 column be narrow. Leave the largest space for the last column. 1, 2, 3, 4, 5, 6 columns are there. Maximum space for last column. And don't copy anything. Okay, you write only the heading. Because once I write the comment, then you can write in the next line, no? Suppose comment takes 2-3 lines. Then we can write number 2 later on. Just write the heading. Just draw columns and once you are ready, you tell me, I'll dictate. Can you increase the speed, my dear friend? Number 1, write number 1, K, this column I am writing now, K 10%, see the first row, number 1, K 10%, C 10%, B0 1000, B0 1000, write the relation K is equal to C. Write the relation as K equal to C. Write the comment B0 equal to Bn. Write the comment B0 equal to Bn. Bond trades at par. Bond trades at par. If there is a requirement, you write in the next line also, no problem. Number 2, K equal to 12%, you can see the board. K 12%, C 10%, B0 927 half. Then you write K greater than C. B0 less than Bn. So here I am going to give a lengthy note for the last column. B0 less than Bn. You write the bond is giving less than investor expectation. Bond is giving less than investor expectation. Therefore, it trades at discount. Therefore, it trades at discount. Then write the last line. Last, number 3. Number 3. K 8%, C 10%, B0 1080.30. K less than C. B0 greater than Bn. K less than C, B0 greater than Bn. Here, bond is providing more than expectation. Here, bond is providing more than expectation. Therefore, we are willing to pay premium. Therefore, we are willing to pay premium over the face value. So this is the first principles of bond. Second, now just see second. What is the relationship you can find between this column and this column? Inverse. Very, very important second principle of the bond. We are going to write in red. Leave one line and write. Put a red box after you write down this. Very important principle of bond. Write down. The expected rate of return K. The expected rate of return K. The expected rate of return K is inversely proportional to the bond price. The expected rate of return K is inversely proportional to the bond price. We can write it as B0, just copy this. B0 inversely proportional to K. Put this in red box. Put the entire thing in red box. Any doubt? Any doubt? Clear? Now, suppose one issuer has come out with the issue of a bond. You are thinking, how I can invest in this bond? See, first of all, you must know whether the offered price is a justified purchase price. Issuer will tell, I am issuing for 1000 rupees. But how to know that price is correct? How to know that price is correct? For that purpose, I need to estimate K. Because issuer will give you only 3 variables to you. They are Bn, C and N. So your duty is to estimate K. So I can estimate K by 3 methods. These are not there for exam and all, but I'm just telling you, you must know, how to, they never ask how to estimate K, they directly ask a problem. They think that you have passed the bond market chapter in Inter. It was there. Bond markets were not there now, therefore they are asking. Okay. See, you are actually, therefore I tell I tell my student, don't bother, just 12th standard knowledge, be attentive, is good in one way, because I am able to train my student the way I want. Suppose had they learned by some other method, sometime you get confused. Now, there are 3 ways I can estimate K. Because I know that once I estimate K, I can substitute in the bond pricing formula and find B0 and compare the price of the issuer. Number 1, compare with another bond. And get K. This we do with public sector bonds. We get lot of public sector bonds, NTPC, ONGC, Coal India Limited, all public sector companies, they come to market, they issue securities. I, as a fund manager of a mutual fund, I have allocated some money to be invested in such bonds. Recently, I bought NTPC bonds, which had a 10-year maturity. Currently, ONGC bond issue has come, which is 9.5 years maturity. See, both are public sector companies, both are Navaratnas, so both companies are of high quality. Therefore, you know what is Navaratna? Navaratna status, no, public sector companies. Government of India has given Navaratna status to companies. So, they are, quality one, the way we have highest rating, like that they are the quality companies. They have the biggest support of the government. Suppose, assume that both are good companies. So, NTPC bond was recently purchased by me at a K of 9.6%. I will use same 9.6% to value ONGC. I will substitute K equal to 9.6. I will feed the parameters of the issue. I will get coupon from the issuer, years to maturity, face value, everything I will get. Find the bond price. Okay, they have come out with this price. Okay, done. First method, compare with another bond and get K. Second, use rating methodology. I can go to CRISIL website and I find what is the rating of the bond. The bond is rated AAA. And CRISIL has given me a benchmark. AAA plus 12%. AAA 13%. AA 15%. A 18%. Remember, as rating reduces, K will increase. Why? Lower the rating, risky is a company. Lower the rating, risky is a company. With risk increasing, my return also increases. So I go to the rating chart in the website. I look for the bond that is currently on issue. That bond is rated AAA, and in a AAA table it is written 13%. I discount using 13%, find the price. So use rating methodology. Number 3, I add risk premium to risk free rate. Now, first of all, you must know what is a risk free rate. When I keep money with Reserve Bank of India, how? I buy treasury bills. Okay, I invest in RBI bonds. So these are money lent to the government. Why? RBI is a banker to the government. When government wants money, they will tell RBI, go to market and raise money for me from the public. So RBI will come out with an auction of treasury bill, Government of India security, okay, other bonds. So I will subscribe to those bonds. When I give money to RBI, what is the chance that money will not come back? Zero. They are termed as sovereign bonds. Sovereign means supreme, they will not default. The return what I will get is risk-free rate. So when I lend money to government, it is risk-free. Therefore, rate given by them is risk-free rate. Are you understanding? So you must be wondering, sir, then what is the risk-free rate? Why RBI is giving me 8%? See, generally when I invest somewhere, there is some risk, I get return. But what is this return? There is no risk. Then what is the return I am getting? It is actually a compensation for time value of money. I give money today, they are giving me after 1 year. So the difference of money, what the value of money from today till next year, that return RBI gives. So risk-free rate is a compensation for time value of money. So now a bond has come. Let us assume that Reliance debenture has come. 5-year RIL debenture has come in the market. And the issuer, the broker is waiting. Can you issue in this debenture? I say wait. You have given me the 3 parameters. Now I will decide on K. So what I will do? K equal to, first, if I invest in Reserve Bank, I will get minimum this. So I must get this definitely from RIL debenture. There is no minimum, I should get minimum. Because without taking risk, RBI is giving me 9%. So I must get this plus. Whenever I keep money with RBI, there is no default. But with Reliance, there can be default. So what I add is default risk premium. Add 2%. I am giving money to RBI, sorry, Reliance, for 5 years. This RF is for 1 year return. RF is 9%, 1 year. Now I am RIL is asking me, I want money for 5 year debenture. 5 years is 1, 2, 3, 4, 5 years away. By the time so many things can happen, I add maturity risk premium. If I have RBI bond, I can go to market, instantly make a phone call, sell and get money. If it is Reliance debenture, it is a big problem. There is a problem of liquidity. Add liquidity premium. 1%. Now with RBI, they generally compensate, they are supposed to and they do compensate for inflation. But Reliance will not do. Add inflation premium. So my K from Reliance will be 13%. Okay, 14%. So I substitute K in the bond pricing formula, find out the price of the bond, tell the broker at this price I am willing to do. So we are also offering at the same price. Okay, take the money, give the bond. So these are the 3 ways we generally estimate K in the real world. This will not be asked in the exam, but still we will write so that we know without estimation of K, no bond market can move. Remember, Once you estimate K, substitute, you get the price, then compare. So we will write this first. Then we will write, we compare with the actual issue price or market price. Then we write overvalued, undervalued, fairly valued, all these things. Write down. Give the heading 3 ways to estimate K. Three ways to estimate K. Number 1, compare with another bond. Compare with another bond. Put a dash and start writing. Put a hyphen and start writing. Here we compare the bond under consideration for investment. Here we compare the bond under consideration of investment with a similar bond, in terms of risk and maturity, with a similar bond in terms of risk and maturity, and use that bond's yield and use that bond's yield within bracket K. That bond's yield, another name I have given now, yield, within bracket K, as a proxy for this bond's valuation. As a proxy for this bond's valuation. Number 2. Use rating methodology. Use rating methodology. Here we use ratings provided by popular. Here we use ratings provided by popular rating companies like CRISIL, ICRA, CARE, etc. Provided by rating companies like CRISIL. Don't know CRISIL? CRISIL, ICRA, CARE, etc. and use the corresponding rate provided in the rating chart, and use the corresponding rate provided in the rating table or rating chart. As K. Write in red, lower the rating, higher the value of K. Write in red, lower the rating, higher the value of K. So we are going to do one problem on rating methodology. This was also, I'll tell you, this was asked once in the overseas exam, and from there I had in my textbook, this problem came in the exam directly one day, and from then they are asking regularly. See, most of them you will find, see, if you actually teach any subject for 20 years, ultimately, okay, you are actually generally from where the questions come. Let me tell you that. At your level, your CMA exam, CS exam, CFNL exam, that is a what do you call domain from where they can ask the question. Overseas examination is where I generally seek, whether I can get a good question, etc. Which I have been doing in the initial 10 years. Now I don't get time. Okay, quite busy. So those whatever thing I've been done, they have all come gradually. See, suppose I tell this problem is important, trust me, I don't know, it's not magic or something. When I see the paper, I remember I had told the students if they have really read that red remark and done, they have seen November 23 paper I saw. Certain things I told, same problem came. Every year it happens. It's not magic. Please understand one thing, it's common sense. Suppose you are asking a child A, B, C, D this time. Next time you will ask E, F, G, H. And next time you will ask I, J, K, L. And after Z is over, you will again ask A, B, C, D. Common sense. So I also use that and tell, mark important, because I know last year what they asked or what is the institute's most favorite topic. I keep this thing and tell. See, you will not have time to do that. So it is not magic or something, some divine or something. We are following this one. Now margins. I told margin they have not asked for 10 to 12 years. They will ask. They ask for 3 consecutive attempts. Okay, so they must be thinking, I have not been asking margin for many years. Let me ask this year also, this year also. So this is common sense. If you have time, I used to tell students earlier, take last 15 year. One girl asked me last year, sir, I given 2 attempts already, third attempt what I should do. I said take the paper from 2018, 2023, total 9 papers you will get, solve each and every problem. Okay, solve each and every problem. I told her, she gave the exam there. Now I found more than 55 to 60 marks was covered in that. Now she just want to pass, just pass. If she had studied properly or remember those problems, only 9 papers, huh? And if she remembered those problems, she would pass. Because you have to present properly. That is the challenge. See, that nobody can help. Even I can't help. So you have to do. So that comes out of practice. So this rating problem which you are going to do, that when we do, you will understand what we wrote just now. And the last line is very important. Lower the rating, higher the value of K. Point number 3. Point number 3. We find K. See, this adding risk premium is our CAPM concept. In CAPM we add risk-free rate plus risk premium. Same concept. What we wrote? We find K by adding. We find K by adding risk premium. We find K by adding risk premium to risk-free rate. To risk-free rate. Write in red. Risk-free rate is the compensation for, write in red, risk-free rate is the compensation for time value of money, is the compensation for time value of money provided by the central bank of the country. Provided by the central bank of the country. Red in blue. This is the minimum return. This is the minimum return any investor will demand. This is the minimum return any investor will demand when he is lending or investing. This is the minimum return any investor will demand when he is lending or investing. Full stop. When we have to invest in a risky security, when we have to invest in a risky security, we must add premium. We must add premium as a compensation for risk. We must add premium as compensation for risk. This premium will account for default risk, maturity risk, illiquidity, inflation, etc. So we are written K can be found with. Now what we are going to learn after the break is, when you go to market, every time you will not get, like this, what you call, okay, this is the offer, you tell me at estimate K. If you ask the market, call the bond market, I want to invest in a bond. Okay, one bond K is available at a price of 758. He will tell 758. So he will tell me 758, and I ask him what are the features of bond. He will give me BN, C and N. So he gives me B0. I have to find K, and I must compare that K with my expected rate of return. It is the opposite that we do after the break.